If you're building or scaling a multi-level marketing company, you already know that the business comes with unique challenges. One of the most common is simply being able to accept payments. If you struggle to find a reliable MLM merchant account, you have likely realized that traditional banks do not make it easy. We know how demoralizing that can be. I'm Charles Crillo, an onboarding specialist at Ally Payments, and welcome to our YouTube channel. In today's video, we'll break down exactly why the payment processing industry labels MLMs as high risk. We're going to cover everything from chargeback spikes to recurring billing issues to regulatory scrutiny. And most importantly, we'll show you how to navigate these requirements. By the end, you'll have a clear roadmap to secure, stable, long-term payment processing that will help your business thrive. Let's get started. So why are MLM companies labeled as high risk? Why can't you just open an account at the bank down the street? Well, it really comes down to stability from the bank's perspective. First, traditional banks often view the MLM business model as inherently unstable, and we all know that the failure rate for individual distributors in direct sales can be quite high. This turnover can signal instability to a traditional bank. Second, for the bank's underwriters, the people deciding whether to approve you, the line between a legitimate MLM and an improper pyramid scheme is sometimes blurry because they don't understand the distinction as well as we do. They often choose to avoid the industry entirely rather than risk making the wrong call. There's also a technical challenge. Most MLM sales are card not present transactions, made online or over the phone. This type of transaction always carries a slightly higher risk of fraud than a card present transaction, where the card is physically swiped, which can increase your risk classification. Think of it from the processor's financial standpoint. If an MLM company fails or faces a major legal issue, the processor is often legally liable to provide refunds to all customers, sometimes going back months. Lastly, banks are highly sensitive to reputation. Because the industry sometimes generates consumer complaints, many banks simply decide it's safer for their brand to just say no. But understanding this isn't about being discouraged. It's about knowing what you're up against, so let's look at the specific issues that cause these concerns. This section is perhaps the most critical for any business to understand: chargebacks. For payment processors, chargebacks are one of the biggest red flags for MLM companies. A chargeback happens when a customer contacts their bank to dispute a charge rather than asking you for a refund. For MLM companies, a high volume of chargebacks is very common. Sometimes new customers or distributors experience what we call buyer's remorse. They sign up in a moment of excitement, but later regret it. And instead of asking you for a refund, they just call their bank and say, "I didn't authorize this." It's also crucial to know that Visa and MasterCard set strict chargeback ratios. Generally, if you exceed 1% of your transactions becoming disputes, your business can face massive fines and the processor might simply shut you down. There's a lot of what we call friendly fraud too. This isn't fraud from scammers with stolen credit cards, but rather real customers who simply didn't recognize the charge on their statement or forgot they signed up. This risk is amplified if your refund policy isn't straightforward or if it's too difficult to navigate. When a customer can't easily get an answer from you, their next stop is always their bank. And remember, every chargeback costs you much more than just the original sale. You're also hit with a chargeback fee that can be anywhere from $25 to $100 per incident. It's expensive and it signals instability. As you can see, chargebacks are a major factor, but the way MLMs sell products often creates additional layers of risk. This brings us to the common issues with high-ticket sales and recurring billing. First, many MLMs rely on high-ticket starter kits, packages that cost hundreds or even thousands of dollars. When a single sale is that large, it creates a much greater financial exposure for the bank if that transaction is later disputed. A single disputed $1,000 charge is a lot more painful for a processor than a $10 sale. Second, the foundation of many MLMs is recurring billing or auto ship programs. While this creates predictable revenue, it also can lead to what's known as subscription fatigue. Customers can sign up and happily receive products for months, but if they get busy and forget to cancel, they might dispute the next charge simply because they didn't want the products that month. Another issue is what processors call unpredictable growth. It seems like a contradiction, but processors actually prefer slow, steady, predictable sales. If an MLM launches a massive new promotion and sales suddenly spike from $10,000 to $200,000 in 1 month, it often triggers a fraud alert. Processors need time to vet your customer base and operations. Because of this unpredictability, processors often require MLM companies to maintain a rolling reserve, holding 5 to 10% of their processing volume for a set period, like 180 days, to ensure there are funds to cover potential losses. One commonly overlooked step is optimizing your billing descriptor. This is what the customer actually sees on their statement. If they bought from Super Life Supplements, but the charge shows up as SLS Enterprises LLC, they might not recognize it, and you guessed it, file a chargeback. All right, so we've covered the technical risks like chargebacks and the business risks like billing. Now let's talk about the people risk. Your greatest asset, your distributor network, can also be your biggest risk in the eyes of a bank. The core challenge is a basic lack of quality control. As your network grows to thousands of independent contractors, it becomes nearly impossible to monitor exactly how each of them is selling your product. Unfortunately, sometimes distributors may use deceptive tactics or make promises they can't realistically deliver on. When a customer feels they were misled about the product's results or the income potential, that leads directly to chargebacks for misrepresentation. It's also important to consider how your distributors accept payments. If they are using their own devices or uncontrolled virtual terminals to take credit cards, they could inadvertently expose customer data, increasing your overall security risk. Processors are always thinking about agency risk. They ask, who is actually responsible for the sale? They worry that without a centralized, professionally trained sales force, there is a lack of accountability. This is why, as your business grows, it's essential to have a clear, strictly enforced distributor compliance manual. Showing a potential processor that you actively manage and police your network goes a long way in lowering your perceived risk profile. Now, we need to address one of the biggest factors in high-risk processing, government regulations. Let's look at how regulatory compliance impacts your ability to process payments. The organization you need to know is the Federal Trade Commission, or the FTC. The FTC is very clear that they prioritize protecting consumers from deceptive practices. One of the single biggest red flags for the FTC, and therefore for your payment processor, is the issue of income claims. If your distributors are promising that people can quit their jobs tomorrow or make $10,000 a week with no effort, those are deceptive income claims. If the FTC launches an investigation into an MLM for these claims, processors will almost always freeze that company's funds and often shut the account down immediately. There's also an element of guilt by association. If the FTC makes a high-profile case against another MLM in your same niche, banks often become very nervous about the entire niche and may tighten up their rules across the board. Beyond income claims, you must have strong processes to prevent things like commission washing or other practices that could trigger anti-money laundering concerns. A major sign of a legitimate MLM to a regulator is the product to recruitment ratio. You must be able to show the primary goal is selling a real, valuable product or service to real end consumers, rather than just recruiting people who buy the product solely to stay eligible for commissions. Ultimately, your merchant account health and your regulatory compliance are inseparable. Processors need to see that you are building a compliant business for the long haul. Now that you understand the hurdles and what banks look for, let's talk about how you actually get that approval. Preparation is everything. Don't just fill out a quick form on Stripe or PayPal. This is the single biggest mistake people make. General purpose providers often auto-approve accounts, but once your first chargeback comes in or your sales spike, they will manually review you, realize you are an MLM, freeze your funds, and shut you down. And this can be detrimental to cash flow. Instead, you need a merchant account with a provider that specializes in high-risk industries like MLM. They will work with you to understand your specific risks and underwrite your business before you start processing, which provides the stability you need. Start by making sure your business is in order. You need to have 3 to 6 months of solid business bank statements, a clean financial history, and if you've processed payments before, your processing statements, often called processing history. When you apply, be completely transparent about your compensation plan and the product you're selling. Show them you're proactive. Implement fraud prevention and chargeback mitigation tools like 3D Secure or chargeback alert systems before you even apply. This proves to the processor that you are serious about managing risk. At Allied Payments, this is exactly what we specialize in. We take the time to understand the unique challenges of your MLM business. We analyze your financial and compliance standing, and we work to match you with the banking partners we know and trust who understand your industry. Don't risk your company's stability with flat rate processors that aren't designed for your business model. We're here to help you get this right the first time. If you have any questions about what we've discussed today, or if you're ready to apply for a specialized, stable MLM merchant account, please contact us at Allied Payments. We've helped many business owners like you secure the processing they need, and we can help you too. You can find all of our contact information in the description below, or just head straight to alliedpayments.com. Navigating the world of high-risk payments can often feel like a full-time job on its own, but understanding why these systems exist is your first step toward building a stable, long-term foundation for your company. By taking control of your chargeback strategy and focusing on compliance today, you protect everything you've worked to build for tomorrow. Don't wait for an unexpected account shutdown to force you into action. Make a plan now. Please contact us at alliedpayments.com. That's alliedpayments.com. If you found this video helpful, hit that like button and subscribe for more payment processing strategy tips. See you in the next video.